Good morning, everyone. How you guys doing? All right. Cool. No intro? Well, I was like a minute late already. I mean, I guess I could have. Happy Easter. How you guys doing? Cold open. Uh-oh. I don't know about that. Will the SPX rise up like Jesus or fall like Lucifer? I'm not sure that the momentum is fully shifted bearish, but I think the next couple days will probably be. Obviously, the news out of China and Taiwan has people on edge. So that's probably going to have some impact on like HSI tonight. Yeah. I mean, right now it's all posturing. Nothing's actually happened yet. We also have CPI and PPI this week, which I'll kind of go over my expectations for. I think it'll be mostly flat with not a lot of pricing increasing across heavily weighted sectors. Shelter's up, so shelter's gonna probably create some. Well, shelter's not only is it up, it's more heavily weighted since the last revision. So um, maybe moderately. Estimated CPI is 5.2% down from 6. But that's like the year over year, right? Year over year should be down. It should definitely be down a lot more than 8 points. I'm more referring to like core month over month. First of all, the Fed doesn't give a fuck about the standard CPI print. They only pay attention to core. And it's the trend in core that has been flat and increasing for the last 4 prints. Which is, the reason people don't think inflation is fully stamped out, right? Year over year inflation being down isn't really fucking relevant. We're still very, very far from the 2% goal, right? Thanks for your tip on how to reheat the burgers last night. I was a lifesaver for my intoxicated state. No problem, man. Your blasphemous stream card shall not be tolerated. By the way, happy Easter. Thanks, Rims and Tims. Cheers to 1 year. Thank you, DH. Thanks for continuing to be a great teacher, Mr. Pickleman. I'm glad you're still doing this for us all. Happy to help. Inflation is solved, everyone. Ignore every tech stock ever. Yeah, no, even if inflation were solved, we'd still be dealing with the collapse in demand, rising unemployment. Like all of those things are inevitable outcomes to the Fed's interest rate increases, right? Is that growth is going to contract at some point. It's going to, be most pronounced in forward guidance and unemployment, right? And when it does contract, there's not going to be any questioning that the future valuations of most of the S&P are dramatically higher than they should be. I want a full port Nvidia Jan 2023 200p. How many contracts is that going to get you? Like 4? I'm just kidding. Yeah, I understand that sentiment, although that's locking your money up for quite some time. 1? Okay. Dollar crash bricks takeover. Yeah, I still don't think that's happening. Is the US going to have to spread freedom to France? Oh, I doubt it. So one of our options or something wanted to go for 2025 100p. Can you ask who it was? I mean, you have enough theta there that your delta is really high, right? So, given the amount of delta sensitivity that has, if Nvidia were to drop to 150 over the next year, that contract would obviously go up quite a lot. Is this week going to be flat or boring again? Or are we going to go down some and get some volatility? Well, I'm hoping that as the discount window continues to close, we start to see a retraction of, all the futures buying that's been going on. I think we're about topped out as far as bullish price action goes. I mean, they drove illiquidity up so fast on SPX and SPY so quickly that the cost to increase the price is now very expensive, right? And slowly over the last week, we see a decline in long position profitability. Has been dropping and over the last like 6 trading days. So actually since before the peak. That combined with I don't know if you guys saw the data JFresh put out on Friday with the out of the money call activity and out of the money put activity. Looks very much, we're trading here around like 4,100. And a lot of this activity is occurring, 4,200 plus and like 3,900, 3,950 and less. This kind of looks like people are selling, large amounts of calls and going synthetic short on the indexes. Which is, oh, no epic pen. Yep, I see that. I'm going to catch it early this time. So just rambling through it for an hour. Let's see here. Where are you, you little bitch? Ah. Aha. Boom. There we go. So yeah, so this is kind of the out of the money call positioning I was referencing. This is the kind of talking about the drop off in profitability for long positions. So right now, where the market stands, it costs a lot more money to bring the price up than it does to bring it down, right? And even given that, put skew is still insanely high, right? So I mean that tells you that there's a pretty significant amount of, I think like the delta skew is like negative 5.4 on SPX right now. Last time I looked. This means that puts are still really expensive given that, price is up and VIX is low. And these synthetic short positions kind of serve two goals. They're gonna pick up a lot of credit, right? They also get to short the VIX, right? So this call selling offsets the fact that they're buying shitloads of puts. And so we see the VIX driving down, even though put OI is going up. So if I had to compare this to anything, I would compare it to like the period before June um, like early June or August, like around SLD. I think we saw a very similar positioning occur in these timeframes. June, a little more so as far as the synthetic shorts are concerned, or yeah, than August. August, the build up in short positions in August was actually really slow, because VIX didn't fall off very much until we started to near like the peak of that like August time period, which was like right around here. Synthetic short positioning built up really fast here in June. But in August, yeah, it took quite a long time, and we didn't see like really big short positioning until out here, right? And then obviously it started to carry through. We had a little bit of a bear rally right there, but ultimately that drove us down. And don't forget that participants are going to be heavily encouraged to push to the downside because of the JPM collar, right? With the JPM collars puts positioned around 38.85, this is a massive downside catalyst that's not very far out of the money, right? I mean, it's what, like 5%? And this is, we're going to ignore the macro conditions and stuff and just talk about the positioning for right now. But yeah, I mean, our current price down to 38.85. Yeah, it's about a 534 basis point drop. Which, puts us right back in our long-term trend, but still above it, right? So, not necessarily, a significant technical breakdown, but a retest of the lower resistance. So I don't think that it's out of the question that participants are going to want to aim for that. And it looks like the put positioning out of the money is, right? It's, a significant amount of it between like 39.20 and 38.50. Now, how long it takes us to realize that is another question. Generally, the downside's a lot spicier than the upside, but lately that's becoming less and less true. But I think the illiquidity and the other factors that are, driving out the long positioning and the advantage of the long positioning ultimately will lead to a downside move. And if that downside move is heavily leveraged, then it'll probably be decent, right? Now that could take a little bit longer. I mean, if we look historically at other periods that were similar, in February, even August, June, you could say here in December, these periods did last about roughly 21 trading days. And we're about, I don't know, like 13 into this one. So, it could be post OPEX when SLD is releveraged. The other thing is, we're massively up right now. And so not a lot of risk off is occurring, which means SLD is likely to be more impactful. Moments when SLD is less impactful, if you look historically, like March of this year and October of 21. These are really two SLD periods that stand out a lot. Well, March of 22 as well. These three stand out. This one a little less so, but these three stand out as being, SLD periods that did not see a decline. And one thing is true across all of them is that they all saw a large risk off into SLD. Right? Market wide. And I think, due to the falling price into SLD, obviously participants are more likely to sell off long positions while they're up. And so by the time it bottoms out, margin in the market isn't very stressed. Whereas on the upside, if you have a big risk on into SLD, a pullback is far more likely. So that's kind of my assessment from that point. I mean, obviously the macro doesn't look good. People are, MSM shifting to, questioning the recession. What if it's going to happen? Like we're not already in one. The shit going on with China is only going to, bring up volatility, which obviously anybody who's been buying puts for the last week would love. Um, so my next 2 weeks means I get to keep acting like a trader. That'd be cool. Do you think we see lower lows, or has the bottom already occurred? I mean, we might not see lower lows until forward guidance becomes more restrictive, right? That's kind of the problem here, is that quarter four earnings, and we talked about this like 6 months ago. Quarter four earnings were a little okay, right? I mean, layoffs and overhead cuts kind of padded EPS across most of the big mega caps, right? And even so against on the large cap companies, right? Except the layoffs weren't huge, right? So it only padded them a little bit, and so we didn't get like a very good recovery with quarter four earnings, but we did get some recovery, right? And then at the time we were seeing inflation sliding. Things were starting to look much more bullish. I don't think quarter one earnings are going to have that same flexibility in their reporting. I think we're going to start to see more mega caps adjust their forward guidance. We already see them pushing through layoffs, pushing through more cutbacks. So that's only sustainable for so long, and this is really this is the part of it that's like really similar to the dot-com bubble, is you had these massive valuations that were largely unsupported by actual earnings, right? And the slow realization of that is what ultimately led to like the dot-com bubble finally bursting, right? It's kind of it's almost easy to see on the chart how similar this period is to that period, right? This is the dot-com bubble back here, right? We had a pretty persistent and sustained downtrend before we had any like real crashes, right? And this is considered like the real crash out here. But we had several crashes as earnings came in worse and worse over time, like little mini crashes, right? Like the market just couldn't sustain price improvement for almost 2 years. And the slow realization that those valuations were not going to come to fruition eventually led to the selling of those assets, right? But it was very drawn out, and it almost looked like it was going to recover until it didn't. But this recessionary period through here, wasn't marked by particularly high unemployment or anything like that. It was, fairly brief, and the market began to recover, by like 2004, in a significant way, and really, if you mark, end of 2003, so it was short lived, and probably far healthier than this one's going to be. And the market's just not the same as it was back then. Speed of information is faster. Sell-offs occur in greater numbers. Leverage is massively higher, right? This was before, they pulled back significant amounts of like Glass-Steagall regulation and stuff. And that ultimately led to the 2008 crash, right? Where over speculation was just crazy. And then we put in all kinds of new new laws to, lock the investment banks in and, try to prevent over speculation. And that slowly over time built up confidence in the market, right? But we still had a 5-year period for recovery before we really hit, break even on S&P, right? And then, now, we're kind of looking at something even bigger than that, right? Already this has dragged on far longer than the dot-com bubble did, right? And valuations are still high, at least in the dot-com bubble. The biggest valuations that weren't faltering didn't really fall off into the end. We still have everything overvalued right now. So yeah, and inflation on top of it. SLD stands for supplemental liquidity deposits. They're a risk management, margin forbearance that is applied to large broker dealers and market makers that participate with FINRA in order to ensure that they are properly hedged and have enough margin to cover any risk that would come from OPEX. You think SLD plus earnings will be enough to cross the collar? Or is there likely another futures driven push end of month if things get too bearish? Well, I mean, the futures reaction is twofold, right? It's partially, bears capitulating and taking profits, and then, that momentum being leveraged to the upside in order for them to re-enter, more bearish positions. And that's kind of what happens on all of these. And it's happened so many fucking times since 2021 that I'm kind of, I mean, like, what's the best way to put this? I'm kind of surprised that we aren't used to it by now. And even I'm not, because sometimes they're just so egregiously, like the pump is so egregious, right? But yeah, I mean, this is no different than what happened here, in the, bear rally, bear rally, bear rally, bear rally, bear rally. But they all break down, right? And they've all been similar positionally, right? They all start with put capitulation that leads to the VIX falling. That leads to out of the money call buying because calls are cheap, right? Calls become too cheap, which we've discussed a lot. And then, futures buying because, the market, it's cheap to the upside. So people are buying futures, right? And then that, drives the VIX further down. And eventually puts become cheap. And then everyone YOLOs into them. And then we go right back to the fucking beginning again. I guess there's one more step, VIX spikes. And these have been pretty, consistent. Not that there's a strict cycle to them, but it's pretty close. But puts are still, I mean, they're expensive, but they're still way cheaper than they were. Right? And they're doing everything in their power to keep them cheap. Right? It's very important that the VIX stays down, right? And that's aided by the selling of out of the money call positions, right? Because that drives, they're selling the vol and then buying puts, and that kind of keeps VIX flat or pushes VIX down. If you sell calls 2 to 1, on puts, right? VIX is going to go down while put OI increases. Was away on Thursday this week and didn't pay much attention. What was the overall sentiment on Thursday's job data and news you mentioned about... Hold on. Sorry, I can't read all of it. News you mentioned about Taiwan. So apparently China's conducting a bunch of military drills around the coast of Taiwan. We don't know if that's something more heinous or just, political posturing. It could be either one. It's up in the air right now. It's uncertain, which is, drives fear. As far as Thursday's job data goes, the job data that came in on Friday, which is far more important than Thursday's, was pretty bearish. Unemployment down overall. Obviously not numbers that, anybody wanted to... Hold on. 1 second. I wanted to see the exact number. There we go. So unemployment down. Non-farm payrolls were down, but mostly in line with like the consensus. And participation rate in the labor market is up, right? So people are making less money, participating more. Same story is continuing to drive, a robust labor market. Thursdays, I think we just had jobless claims. And they were, above forecasts, but below the previous level. But those are, month over month or week over week. So those aren't very important. We also have bank earnings this week, along with CPI and PPI data. And I think a lot of investors are very interested to see how the large banks are faring, in their earnings compared to the regional banks. And I think their earnings will be heavily scrutinized. You make this manipulation seem super obvious, but on my own, I'd never think of this. Thanks to the education. No problem. The hardest part about it is, if you're positioned to the put side, the shift from, put capitulation to long interest happens super fucking fast. And you can absolutely be caught off guard by it. And it's not, this time it wasn't universal across the entire market, right? Stocks like Nvidia, Microsoft, Netflix, the big FANG stocks, they all stayed up through most of the whole period, from February's SLD drop, through, and generally speaking, in previous instances that this happened, it's been very valuable to be short, those big mega caps, because that's where money flees first and hardest, right? Because it's everyone's core investment. And this time, tech really didn't get hit along with everything else. That was, so, it definitely can throw curveballs at you, even if it is moderately predictable on a macro scale. You do have to exercise some risk management, and it almost enforces the skittishness that causes the cycle to continue to occur, right? So instead of, us going down and then, big leverage coming in and pushing down even further and further and further, bears get skittish because they don't want to get burned by other bulls capitulating, right? And so, you end up with everyone just, feeling skittish overall because, oh shit, we've made too much money, right? And everyone starts bailing on their positions, which reinforces the cyclical nature of this. But this is, I agree. I do not think that it's sustainable. For it to become sustainable, we need to trade. This is what would have to happen, right? We would need to trade in the upper range, until liquidity came into the equities markets, right? So we would need to kind of stabilize for a long period, which we've never gotten to do. Greater probably than like 45 days. And then, either sustain like this or sustain upward for about 45 days. And then, allow liquidity to come to terms with the shift in market action. And really to get that, you need someone to bring liquidity in, right? And that's also not something we have right now. To get a true bull market, we need banks to start pulling back their repo operations. We need them to stop massively buying treasuries and start focusing on equities. And without that, and I think that'll be our best sign of when we start to return to a bull market is, we'll start to see our RP fall off. It'll probably be even more obvious in that the Fed will begin to decrease the overnight rate, right? Making that no longer a valuable proposition for large institutions, right? Right now you're looking at an overnight rate of like 4.85, right? And 4.85 beats the returns you're going to see in the market day to day by a lot, right? And so everyone wants to, and that's quantitative tightening, right? Everyone wants to take their money out of equities, out of bonds, and throw it into overnight repo, where they can make 4%, because that's, what the fuck is growing at 4% right now? Nothing. Not really, right? Like valuation wise, and anything growing at greater than 4% right now carries a massive amount of risk, which, we've talked in the past, institutions are very averse. And so, it is the best proposition, but, if the Fed begins to lower the overnight rate in line with accumulation of growth, we'll start to see that liquidity, all that money, come back into the market, right? And that's going to encourage people to buy stocks because, prices are going to start to go up, and they're going to go up in a stable and consistent manner, right? They're not this fucking, we rocketed 300 BPS in 3 days. That's not how bull markets begin. Like, that's not a sustainable bull market. That's, a pump, right? It's entirely positional based, regardless of what the news says, right? The news will flip flop every day. They're largely owned by hedge funds. And these are they want to scare people out of the market too. That flip flopping makes people feel uncertain, which we've talked about, makes more fear, right? And fearful people do what they're supposed to do, and they jam their money into 401ks that largely lose to inflation over time, right? While paying out billions and billions a year in management fees. No one's going to trust themselves to manage their own finances in a market that's so unstable and all over the place, right? And the primary beneficiaries of this are the people that own the news networks that are reporting the news. So it's, yeah, what are you going to do? So this week with CPI, PPI coming out, could there be some more speculative future pumping before the data comes out? And what reaction after is heavily dependent on the numbers plus bank earnings? I don't think CPI or PPI are going to produce very positive results, right? Anybody long in the market is going to hang on the fact that the year over year is down. Anybody short the market is going to point out that core is up or core is flat, or that, prices are increasing in one sector or the other, right? Like they'll just compartmentalize the information and take what they want out of it, right? And this is one of the reasons why I focus on positioning in the market and follow what, the money's doing versus, following what, everyone's sentiment is, right? Because sentiment can only drive markets so far. And, retail's influence, regardless of their sentiment on the overall pricing in the market, is nil. I don't care if, only maybe in mass and on like a single equity, like GameStop, where everything was extremely hyper focused, can retail really create risk in the system. Um, on things like SPX and stuff, I mean, everybody in America could buy a fucking call on SPX, every single individual, and you'd have a hard time rolling over the market maker hedge. Whereas JPM can do that with one position timed appropriately. Right now, it looks like money's flowing into the put side. People are buying puts and they're selling calls at a pretty high rate. I would say they're selling more calls than they're buying puts, and so that's extremely bearish, right? Now that can continue for a few days, right? As that positioning continues to set up, especially as we move through the data points, right? Through CPI and PPI and bank earnings, which are probably going to be, bearish. Even if they're not bearish, the assumption will be bearishness because they'll be so heavily scrutinized. Like, it's kind of odd that in a high interest rate environment, right, none of the banks are doing better. Like the banks at this point, with the federal funds rate at like 4.75 to 5, should be fucking killing it, and they're really not, right? They're like net interest earnings are kind of slim. And I think that's going to get extremely focused on by investors because, well, of the risk in the banking system now, people are going to start to notice, right? It's going to be a lot harder to deny. And yeah, banks should be killing it, but they're not because they've taken so much risk everywhere else, all through 2021, and all of that accumulation of wealth that occurred, has gone into assets that are largely illiquid now because the yields are up so high. Is there a number on SPX, or if we are above that, we should be short-term bullish? On my chart, it's 3,800. Also, SLD enough to knock us out of the uptrend. Actually, it's just gamma neutral and the gamma flip points. So I kind of tried to math out what they're doing with these gamma flip points, and I think what you're looking at really is you're looking at like our gamma neutral, which is macro, right? Our gamma neutral is it's a combination of all strikes, all dates, right? Like we're finding like the true gamma neutral of SPX in a given time period. But like these gamma flip points are like shorter dated gamma neutral essentially. And are, obviously more influenced by I still don't like the calculations they're doing, and I don't trust them, but they're far more influenced by shorter dated positioning than ours is, right? And so, our gamma neutral, like the true gamma neutral, is what's it around Friday? I don't think I looked at Friday yet, so give me a second. Yeah, so our gamma neutral as of Friday is at 413.07. Or 4113. Right? So above this, puts get cheaper. A lot cheaper. And we spent a little bit of time above this week, but mostly we failed to break to the upside of it in any significant way. Here, I'll move down to the 1 hour so we can kind of set this and see a little better where we're trading around this price point. Let's do a line here, and then I'll try to make that bigger so you guys can see it. Let's do was it 41.13.07? Right. So a little bit of the first part of this week was spent trading just above that gamma neutral point, right? With the shorter dated gamma neutral pretty much persisting at 40.80, right? So shorter dated, puts are cheaper above 40.80. Longer dated puts cheaper above, 41.13.07. And if you look at that range, we traded very much within those two ranges, right? Put interest really started to accumulate here. That dragged us down. But we've managed to hold the 40.80 line into the end of the week. I think the spike in overnight futures on Friday, or Friday's briefly open futures market, puts us somewhere back around the 41.20 mark. But obviously this can change tonight when futures open. So some stability, I think, in this price range for now is likely until either, bearish data or SLD. So if the data isn't bearish, I think we'll continue into SLD before we see a significant downside. In the meantime, probably a lot of chop in this range. I mean, at the beginning of the week, I set our neutral range here around like 40.65, with the upside at like 41.03. Or 41.05. I think this might have been 41.05. Yeah, it was. 40.65, 41.05. And we stayed, or 40.80. We stayed mostly, like most of our volume traded throughout the week stayed within that range. To the upside of 4100, it skews bullish. To the downside of 4100, it skews bearish. It's not particularly difficult to trade it, but it could persist. So I think under 41, 40.80, where we cross that, to answer your question finally, under 40.80, where we cross to the downside of the bullish positioning, right? And the market maker hedge begins to turn in favor of put positioning, right? The market maker begins to sell, and you can think of it as like degrees of selling, right? So, if price is up here, as we approach gamma neutral and past gamma neutral, the market maker sells more and more into falling prices, right? And the further we get away from gamma neutral, the more compounding that effect becomes, right? So first you have a small slip, right? And that's dramatically increased, and it starts to really move, right? And the same is true for the upside, except we're not really moving into a strong positive gamma environment, right? We haven't forever. We haven't stayed consistently in a strong positive gamma environment for a very long time. Yeah, kind of think of that's how it breaks down. Very important resistances are probably like 40.75 right now, 40.50, 4,000, then 39.50, 3,900, 38.50, right? Like the further down we move, the more accelerated that downside price action becomes. Continental told me he has May 8th, 450 Ps. I told him he's fucked. What do you think? You're the same person. Also, that guy has a bitch name, don't you think? Yeah, I do think you're a bitch. I mean, May 450s don't seem very bad right now. I mean, they have plenty of time. They're in a very decent range. Kind of right in the middle of the bullish and bearish positioning, so I don't think that's a bad strike to capture downside, and I think May 8th is a decent amount of theta. Yeah, there's some gaps that need filled. Any thoughts on nat gas? It's really cheap, but supply is sky high, so it's like, do you bet on it? Nat gas is, man, I don't like playing it. I really don't. I have exposure through BP, but BP is also oil exposed, so it's performed well since I bought it. Um, I wanted something that had some nat gas exposure in case nat gas rocketed again, but I didn't want too much, right? And so that's kind of why I chose BP. Devon Energy is another stock I own that has some natural gas exposure, but it's also minimized against their oil exposure. Straight up natural gas exposure right now, I think is really risky, even though it's so low. And it's like everyone's like, oh, it has to come up. Not right now, not necessarily, right? It could be some time before natural gas spikes in price. And I think there's been so much concentration on increasing the supply and increasing the capacity of storage that through Europe especially, that it's kind of risky to go long on it unless you have a couple year time horizon or something like that. But that storage capacity increase and that production capacity increase could persist for a decade, right? So it's just so the risk of going long is so high that just saying like, oh, it's cheap, I should buy it, maybe not true. Also, we're heading into summer where natural gas demand is seasonally lower. I don't like it. I don't like it. And I'm not saying that there can't be a shitload of money made there. All kinds of stuff could happen, right? Russia could fucking bomb Europe's natural gas storage facilities. Who the fuck knows? But that hasn't happened, right? So, you gotta get on some like pretty big conspiracy in order to assume that something's going to drive up the price of natural gas right now. Do my April 21 puts have some hope of going green? I don't know where they're positioned, but possibly. Okay, I can't deal with split personality walking. Change your fucking name back. Stop being an asshole. We all know you're also walking. Like it's not a mystery to anybody. No one's like, I don't know which one's walking. Is one of them walking or neither of them walking? I thought walking was banned. We know you're fucking walking. Just go by your actual name. I don't have time for this. All right. Do we actually have more questions? Did I answer all the questions? I thought I did great. So it was an awesome stream. I had a lot of caffeine this morning, so I'm fucking going. Calm down, SH. Thoughts on Tesla this week? All right, well, Tesla found some support at the 180 the other day. I closed out some more short dated puts. I'll probably look for a bounce here going into CPI and PPI data. Tesla keeps discounting their shit, and that's going to be realized in their earnings. And I think a lot of people are kind of scared of that. So near term, I think there's some potential for maybe more put entries if it comes back up to that like 188, 190 price. I would be probably pretty interested in DCAing some shorter dated, and by shorter dated, I mean like 30 to 45 DTE puts. Above 190, I'm much more interested in buying into the long-term puts where I'm targeting like, 180, 170, right? And those I've been kind of slowly accumulating when I have a chance. I managed to get a few on that breakout that Tesla had, even though that was short-lived. And I got a few more near open here. It was kind of shittier than that. It was like right there. And those, I've been, these are my short term targets, and these are my long-term put targets. This is the mid. This is the final PT. So yeah, I'm still really interested in targeting this 170 range over like 60 to 90 DTE. And I'm interested in targeting this range in the 30 to 45 DTE. I've been mostly just closing. These tend to be fairly short-term trades. I'm buying the theta in case I need it. Like if it moves against me hard unexpectedly, then I have some time to average down and catch the downside. But I mean, the few times I've entered them, which have been here and over here on the short dated side, I've mostly been stopped out of them. I got stopped out here. I got stopped out here. So they tend not to persist. The longer dated ones I've been buying since around then and averaging down over time. So yeah, I think with the direction volume's taking right now, Tesla may revisit the upside here, but then it's probably just gonna make me want to target like 185 and 180, right, with shorter dated puts, and then also while still continuing to target like 175, 170 with the longer dated puts. Obviously, I'll look for a rejection before I enter anything. Probably confirm it as well, but that's kind of my thoughts on Tesla. I don't think they're moving back to like 300 anytime soon or anything like that. And if S&P or SPY and QQQ fall, Tesla will inevitably fall very hard. Liquidity's dried up. The OPEC potential that it had, mostly dead after all of this, right? So liquidity's pretty normalized on it. Obviously Tesla doesn't run as hard post-split as it used to. It still runs really hard. I mean, far harder than like GME does or anything. But yeah, I think mostly that's resolved. Touch on Nvidia. Okay. Obviously, Nvidia's price action looks like it's starting to finally round out. We've got our liquidity comparisons to historical price movement here on Nvidia. We are reaching the upper range of its like liquidity versus its larger holdings. This does not account for all of them. And so on something like Nvidia, this is far less accurate because Nvidia is already so liquid that its market is generally pretty efficient. Although, this would indicate we are seeing some inefficiency. In Nvidia's current market. And the breakdowns of these tend to be bearish. So we're also seeing an accumulation of sold calls above 280 and 275. We're starting to see gamma neutral get very close to the current price. We're starting to see gamma max move out beyond the current pricing. Both of these are pretty bearish. Delta neutral starting to turn down. So, all of this indicates that it could be, maybe a couple more weeks before we see significant downside on this. But I think, based on a lot of the sentiment I'm seeing, when Nvidia does turn around, we will we will very much get to test the theory that retail's buying power leverage to the short side produces far greater returns because people are buying shitloads of puts on it. It's really starting to obviously stand out as something that is drastically overvalued. And it's taken some time, but, you know, eventually all the marketing in the world can only get you so far, right? Before people are like, man, this really seems like a very good short. And so we may have been wildly early, but I don't think it will necessarily be wrong. I'm still trying to be conservative with my price targets. I'm still targeting, you know, 200, 220 over the next 3 months. I'm not trying to target, you know, 150, 180 until, you know, much further out in the year, like September through January. So I've been buying my further out of the money calls or puts I've been buying at, you know, like the September and January expirations, where liquidity is good. And, you know, those puts are, you know, they're cheap, but I think over that, you know, 6 to, was it 5 to 8 month period, we can see more of that downside. But right now, you know, in the shorter dated, like the May and the June calls, I'm really targeting, you know, 240 to 200. Because, I mean, I'm trying to be realistic about how fast it's going to come down when it comes down. And that seems, I mean, not what I wanted, but more in line with the current price action. Will the yield inversion flip back to normal as soon as rates are cut? Should I get ready to go whole account TMF? I mean, not right away, but slowly. I don't think it'll just snap. Like, I don't think the yield inversion will just snap back from where it is. But that also depends the pace of their rate cuts, which we have no idea about right now, when they do happen. I should have sold my 421 39.90p last week. Should I take the L and reposition? You could. We might get some downside this week. Don't forget that, you know, we can still test that lower, like 40.80, 40.75 range. Even if we do stay like moderately stable in our pricing through next week, I don't think that downside range is going to remain unseen, right? We'll probably move fairly volatilely through that, you know, 40.80 to 41.20 range. So, you know, if for 41.05, if you're taking a big loss, it might be worth waiting like the extra day to see if we hit 40.80. I'm waiting to buy back my 421 187.50 cc's. I don't want to hold those through earnings. You probably had a pretty good chance to buy them back this week. I don't know. See how the market performs into tonight. You know, make your decisions from there. Obviously, you don't want to buy them back if they're back in the money, but there's definitely resistance at, you know, 48, 187.66 to the upside, and the current price action could just continue to break down. So, what do you think a healthy percent of a port is to be cash in this market? I'm around 50%. I feel like I'm missing out on potential plays. Is this simply impatience for the right opportunity? I don't think 50% cash. I mean, I'm not a big proponent of, you know, cash as a position. I tend to play the market over shorter time intervals than that. And so, yeah, I mean, I think cash is at this point just losing to inflation. But I think if I were to deploy what would otherwise be a cash position into equities or securities, I would probably, you know, focus on either something very defensive, something commodity or energy exposed, or alternatively, I would just buy treasuries with it while I wait out worse market conditions. So I think inaction is never the solution. I know a lot of value investors disagree with that, but especially in markets, this volatile and with inflation this high, um, you should be actively trying to do something with your money while maintaining low risk exposure. So I mean, the 3 month yield is at almost 5% again, right? I understand that's annualized, but that gives you more than enough time to like hold a cash position until the market satisfies the conditions you're looking for. And even if you were to miss the bottom, you wouldn't miss it by very much. So things to consider at least. I mean, not that there's anything wrong with just waiting, but you have to presume when you do that, you're presuming that by waiting, you're entering at a period where forward returns are going to beat the time cost of the money held, and I don't think that's going to be necessarily true over the next like 3 to 5 years. What do you think about long butterflies on SPX? SPX is too volatile right now for like butterfly or condor strategies. I'm not a big fan. Since you just pay attention to positioning more than macro, what made you not switch to full bull on Nvidia during this run? I mean, I bought calls on Nvidia. Positioning on Nvidia never got insanely bullish, and I think it's partially because we're too hyper focused on its options chain and not focused on the compounding effect of ETF buying on Nvidia, right? Um, which is obviously something we'll pay more attention to in the future, but uh, you know, we've spent so much time looking at things that are illiquid and the effective derivatives on those illiquid things that when faced with something kind of liquid, it's easy to ignore where the liquidity is coming from. But I did my best to salvage my position on Nvidia. I've been selling calls naked above gamma max every week, and I've been selling puts below gamma neutral every week, week over week, in order to offset the time decay on my options positioning and help fund the rollover of those positions into further dated strikes. So I'm taking wide strangles on a weekly basis and trying to capitalize on that. And I have bought calls on Nvidia during this run a few times. When it started bouncing back from the bottom at 225, I bought calls on it then. I bought calls on it when it started to push up towards Gamma Max. I've bought, some zero DTs on it when its chain looked pretty bullish on going into Fridays. That's all of those have been helpful in offsetting the cost of my put positioning as I carry it. But they also help me add and average down my put positioning, lowering the cost basis of that position over time. Some positions, unfortunately, have to be heavily managed like that. Sometimes you are very wrong in the short term, even if you do end up being right in the long term, and you have to either abandon your thesis, which is one option, which I considered, or you have to commit to it and try to find a way to continue holding the position while earning money on the near-term price action, right? You have to offset the cost of holding that position. And so, when you look at institutional puts or institutional shorts, and they're like, we say things like, they can be short forever. They can, right? Because they know how to manage that position in a way that they're not going to lose money by remaining short. And managing positions like that is something I hope one day everyone in here learns to some degree, because even a small amount of it can offset massive losses. Amazon, I mean, I don't know. I think it would be good for Amazon to buy Fubo, but yeah, we were just trolling. It's just big trolling. There's no actual acquisition news. I think any content creator at this point would be wise to try to buy Fubo, but especially as we move towards like a stronger M&A environment, right? I think Fubo will be a big candidate for that. It's one of the reasons I was so interested in it in the first place, is it was very cheap. Even at $3, it was very cheap, given the amount of content that they have licensing for. And larger streaming platforms would benefit from acquiring that licensing. Very simply. Sup, Pickle Man? Happy Easter to all. What's up, NW? How you doing, man? Oh, hey, look, it's Jay Fresh. All right, I'm gonna talk to the cat. What's up, man?
Hold on one second. I was listening to you on YouTube, so now I'm hearing you twice.
No worries.
Oh my gosh, I cannot work this. I'm just going to close it. All right. What's going on? Happy Easter.
Happy Easter, man. Nothing much. Just getting some of my weekend thoughts unloaded onto everyone.
Yeah, I thought it was pretty good stuff. A lot of the questions that I expected. When go down.
When go down. The question on everyone's mind.
Yeah, so I know you said you think it's going to chop for a while, and then weird. Two things that have been pumped a lot on Twitter: Tesla and artificial intelligence.
Yep.
Like, I'm pretty sure there's bots that just go on anything that's related to cars, and they just like post, "Should have bought a Tesla. You know, it's the best car I've ever owned," or something like that. They're just everywhere. But anyway, yeah. So I don't know how I feel about going long or going short on Tesla right now. Just I think there could be some room to the upside before it inevitably tanks.
Yeah. I mean, most of my short position on Tesla is short. Short. Like longer shorts.
Yeah.
I've been targeting like June puts and May puts on the short term, but the May stuff's been good. I think their earnings aren't going to be great. They've been cutting prices for the last two quarters, so
5 price cuts is.
But Nvidia is the all-star of showing that it doesn't matter how much money you earn as long as people believe you'll earn more at some point.
Well, I mean, anything right now, right? Wasn't it Samsung?
Yeah, Samsung just reported 97% drawdown in year-over-year revenue.
I couldn't tell if it was a report or if it was a guidance adjustment, but yeah, they basically came out and said, we're going to lose money on chips for the first time ever, and our revenue's down 95%, and the stock went up like 4%.
I thought they released that over the weekend.
I don't know. Well, it's all. I don't remember what time it was released. I thought it was maybe released Thursday night because it's only traded in Korea, right?
Yeah.
I don't know. Who knows? That's the problem with Twitter. All my information's just been fake for the last 2 days.
Probably.
But yeah, I mean, I kind of just agree with your assessment of CPI is a really important number and people base a lot of decisions on it. But we're kind of at that point where people are just going to see what they want to see in the numbers. They're not going to be so wildly skewed from expectation that it destroys anybody's bias, so thoroughly that it changes much, is kind of where I'm at right now.
I agree with that, yeah.
There's going to be, energy's still going to be low, right? That hasn't really, any increases we see from OPEC's going to take a while to come in.
I mean, oil's up still.
Yeah.
I think if anything's driving fear in the inflation print, it's the fact that oil surged back up again on the Saudi production cutbacks.
Yeah, but that's not going to show up in this print, right?
No, next one. Housing's
So,
up.
but
Housing
yeah,
and housing
that's
services are still continuing to rise.
housing's up. All the things that have been up are continuing to be up,
Yep.
and all the things that have been down are continuing to be down. Now, I have seen some indication that used cars might be flattening out as sort of there's a couple of
Well, they're less
supply and
heavily
demand.
weighted now.
Yeah,
Across the board, auto's less heavily weighted. So I mean that was what everyone was expecting in February, was for auto's deflation to be factored in heavily into the CPI print, but then they adjusted it and took the weighting off of it, and so it was no longer having the deflationary effect that people were hoping it would have, and that kind of sucked a lot of the bullishness out of that
yeah.
particular print.
I mean, I think that's a smart decision in general because it's so volatile and it's so obviously. I mean, it can't stay. It's not going to stay low forever because I mean they still have dramatic supply chain issues, and that's you can only forego having a car for so long. It's kind of something a lot of people just have to own no matter what.
Yeah.
And I've heard a lot of people discuss, it's like, well, why buy a car? Why not just hold on to your car for longer? It's like, well, if you have an older car servicing has also skyrocketed, and so you have to weigh the decision between dumping a ton of money into a clunker that might not ever get fixed versus just getting something at least runs today.
Remember when I was
So
getting
yeah,
all bullish on O'Reilly like a year and a half ago?
yeah,
It's done
it did.
very well.
All of them have, yeah.
Yeah. Well, no, not all of them. I think Auto Parts something has not done well.
Oh, really?
Like AutoZone and O'Reilly have done really, really well, but
Oh, Napa Auto Parts.
Advance Auto Parts has done terribly.
Okay. I don't even know what that is.
There's
Let's
like
try it out.
another like fucking auto parts store.
Yeah. Yeah, so I'm interested to see if cars kind of start to flatline. A big one for me, if you look at the CPE data from last month, the
Uh-huh.
big things that were down were cars, healthcare, and energy, right? And we know energy is probably going to be somewhat flat. We kind of hit a bottom around this time, around that time.
Yeah.
Cars may be flat. Healthcare is interesting because healthcare costs were down in the PCI or in the CPI print last month,
Uh-huh.
but healthcare costs were up
And
in the
PCE.
PCE print.
So that's
Like,
kind of leading back to like what I was talking about a little earlier, and that like that year, so many people are intentionally focusing on the year over year number, right? Which is
yeah, I
averaging,
look at the month over
but
month instead
the
of
month over month
the 3 month
CPI,
trend.
especially core CPI month over month, has a pretty good chance of coming in hot.
But yeah,
I
I
think
agree.
even though we don't have that energy cost in there yet, right? And people know to expect the energy cost increase in May's print, right? And so I do think that like our month over month core is either going to be flat-ish or slightly hot because of the increase in healthcare. Because everything else looks pretty much the same, right? But there are like some, and healthcare I think is actually weighted pretty heavily.
I have to imagine that they are factoring in the cost of energy in the production and delivery of virtually every other good and service. Is
There,
that when they exclude food and energy? Do they exclude the cost of energy
no.
baked into the other
So
goods?
they exclude
So
the energy sector price increase, but they don't exclude the effect of the price increase on goods from higher energy, which is what we
yeah,
saw
so
after the Ukraine war when energy, like inflation went super hot, right?
yeah.
That was all
Well,
driven by energy, but even though energy wasn't factored into core.
then that's another issue too going into summer is if we aren't getting appreciable disinflation or whatever you want to call it, then core CPI and core PCE are gonna get a lot of pressure from rising energy prices, which right now they've been enjoying some pretty nice cuts to energy, and obviously that's over now, right?
Yeah.
So yeah,
Well,
I
distribution. I mean, PPI is going to be far more impacted by rising energy costs, generally speaking. It takes like a couple months to roll over into like food, like energy costs, like especially oil increases take usually like 1 or 2 months to start appearing in the consumer price index, especially like impacting core. But the realization in PPI is very immediate. And if PPI surges up, right, then the next rolling period over, you'll probably see that effect realized in core CPI.
yeah, I mean, the ultimate issue is that right now we're talking about pretty secondary or pretty deep dives into the data, and it's probably not going to have as much of an impact on the market as everybody hopes, right? I mean,
I
I
mean
think the
that
bulls
depends
will
on how the
continue to be
Fed
bulls.
treats that data, right?
Well, sure, but I'm talking like in the next month or the
Oh
next
yeah.
3 weeks, right? So I mean, I don't foresee there being anything at least planned, right? And there's always unplanned events that occur, but any planned data I don't see as being a catalyst for really anything.
I don't,
So
I don't,
yeah,
I
I
don't
mean,
think the data really needs to be one. Positionally, I think the Bulls are about at the end of the rope.
I mean,
Um,
I want to believe that, right? But
that's
every week
fair.
they keep showing us that they've got a little bit more in the tank. But no, it's actually been really interesting. I've been looking at the Fang. I guess we call it the Fang MG. Or, I don't know. You know what
The
it is, the Fangs with Google in it, or no Fangs with what's M
Microsoft.
FAANMG. Yeah, Microsoft. Yeah. And if you look at, so I've been looking at a couple of interesting data points comparing the Fangs with the rest of the S&P 500.
Mm-hmm.
And actually, there's a lot of things that look sort of like the COVID crash. And I'm certainly not implying that we're on the precipice of a exact repeat of the COVID crash, which obviously the same events and factors that were present there are not necessarily present here. But one interesting feature of the COVID crash that I thought was quite interesting, and maybe I'd have to go back and look at other crashes to see if this is also true, but the market cap share of the Fangs and the SP 500 just went straight up, and before the crash, and then during the crash, just continued to go up. And so you could interpret that as being a flight to safety, right, or perceived safety, right? And I think
Yeah.
that very
Mm-hmm.
much is similar to what is happening now, right? While people are flying into bonds and money markets and into these Fang M's or whatever you want to call it, very much in a similar way that they were right before the COVID crash. And if you look at like the share of market cap that they've gained, it's larger than pretty much any other time since 2013, except for the COVID crash. And so,
I'll pose an alternate explanation. Those are the most heavily weighted stocks across the indexes already. So if you need indexes to go up, you buy them.
well, sure, yeah.
Yeah.
Well, yeah, I mean, I guess so. There could
I mean,
be
especially preceding like.
large nefarious forces, but I guess they buy those to sell off everything else. I don't know.
Mm-hmm.
What purpose would they have to just be pumping them in the short term, just to sell off everything else?
Yeah.
Yeah, yeah. I mean, I
I
could
mean, they're
see it.
selling off everything else. We know that, right?
Yeah, I mean, if you look at the market cap, so the market cap of just those how many stocks? 6 stocks has gone up about 100 billion or so in since the bank failures.
Yeah.
The market cap of the rest of the S&P has pretty much stayed flat, if not gone down a little bit. So, yeah, there's nobody's. Nobody's buying indices. They're buying they're buying Fang M.
Well, I mean, that's kind of like what our research has pointed at, right? Largely is that, market participants, informed market participants are always aware that a crash is coming or a serious correction, well in advance of the correction, right?
Yep.
So, and I think that might be mostly irrefutable at this point because we've seen that evidence across multiple data sets. So, if that repetitive action is present in like every crash, then it makes sense, right, to buy the index, like the highest index weighted stocks, right, and then sell all your other assets, and then you dump the index weight, and then the index dumps, right?
Yeah.
Because like notionally,
happened.
most funds across their core position are probably equally exposed, right? And so by driving interest into the smaller but more heavily weighted subset of stocks, they're able to shed all their other exposure at very high prices, thus minimizing loss when they sell core position or have more heavily weighted core positioning. You could probably use like an equal weight index for S&P to track that.
Yeah, I mean that's kind of what I've been starting to do. Just kind of comparing the relative performances of those things to kind of get an idea of how that's occurring. I need to back test this beyond just the COVID crash. It'd be great to look at 2008 and maybe even .com. Although I guess that would be the first potential one, right? Because tech didn't really. So yeah, I mean we don't have a whole lot of data to go from, right? The maximum we can have is really 3 strong data points. You can fit just about any line and make whatever conclusion you want when you have 3 data points. But yeah, I mean, I do think it's interesting, and you think about like, there's a lot of this. I think we all agree is momentum based. I don't think it's really based on people being extremely bullish.
I mean, I think there's a faction of retail that has been tricked into being bullish, more speculators than long-term investors.
Let me put it this way: this hasn't been driven a lot by resilient bulls, right?
No,
so
this isn't driven by institutional bulls. I don't think. I
think the second it turns around, all those people that were bullish start to become scared, right? They just all made a bunch of money in a very short period of time. Some of them just bought in at the top, right? And so when that turns around, that it can turn around as quickly as it goes up, right? And so I mean, everything inside me says that never underestimate the bulls and always expect the worst. So I kind of am trying to expect flat, maybe even slight up for the next couple weeks. But I don't think it's got much beyond. I think we're gonna hit the momentum to the downside fairly soon. Because I mean, I just keep looking at all these places where all the money's going, and there's just not much upside left. So
I think we're gonna see.
I said that 3 weeks ago.
I mean, positionally, like looking back at our historic data, I think we're gonna see something very similar to Feb, where we continue to trade in this range as more positioning is built before actually failing. Although the positioning that came in Thursday last week was intense. So maybe we don't have that long, but a similar effect, right? Where, the bullish momentum loses steam in favor of much cheaper short positions.
Yeah. I mean,
and if we go back and look at Fed, it's really obvious how that played out, right? And then it finally fell off.
Yeah, I mean that's the hope, right? I think
remember that fucking this week where we were just trapped above that position at 4,100. That call position that was like $40 billion or something. When Icahn bought his fucking futures shorts.
Yeah, it'll be an interesting week, I hope. Otherwise, just chop.
Yeah.
Hopefully it'll be less boring. I mean, another thing that's interesting too that I don't know that I fully really digested is the fact that, I mean, you touched on this a little bit in terms of the liquidity, but the volume is just so low,
Yeah.
so
Yeah.
low. And I
Friday
know
or
that's
Thursday, SPY volume was what, 30% of its 10-day average?
it was something awful. Yeah, I think it's down 30%. I don't think it's ever been like a more than 50% under its average, but yeah,
There,
it's rough. Nobody's buying shit.
no. I mean, and there's so many other pieces that are fitting into that, right? Like, we see evidence that the discount window is closing on the Fed, which means future speculation is going to start to die down. Um, you know, as that closes out over the next, 60 days, from when it started to spike. And then also, we see money market flows are up, almost at 6 trillion. That means most of retail, especially like if you look at, uh, I can pull that up actually. What is that fucking ticker? God, it's so hard to find like the terminal tickers on here.
Yeah, are you on TradingView?
Yeah.
Yeah, it's a little rough to find some of the more obscure ones. But yeah, I mean, there's no volume. Uh, there's definitely been some flights to safety. Banks are an interesting one. I think that
Oh,
obviously
here we go.
bulls. Oh, go ahead.
Yeah, this is the money market index. Since February, money market flow. So this is your boomers, your retirees, your 401ks. They're all pumping money, and like this is retail sentiment, right? Retail with money, at least, or wealth. They're dumping their money into safe investments, right? And then we can see that in, if we overlay like move through a similar time period. We just do same percent scale. No, it's not gonna work. I'm gonna have to tone that down a bit. We look at bond flow through the, bond volatility also spiking through this time period. Yields are up again, which, the higher yields go, the more they're going to bury all the bond positioning that occurred during this period, right? So if yields move up again, um, all of these are now going to be underwater on the yield curve. And so I think, and I think you can see that with like if I open up the 2 year as well. I
I
think
feel personally attacked right now.
I know you do, but
No,
that's
I'm
just
fine.
because you bought the mid. But yeah,
I
you can
mean,
see the same thing with like the 2 year flow, right?
yeah, I saw it was creeping up on Friday.
And then the Fed discount window is obviously falling off. So I think there's no doubt where money is not going into bullish things. Some money is enough to pump indexes, but
Yeah.
in the macro environment, the majority of money is going into safe havens. Also, let's talk about fucking gold, right? Like,
Oof.
look
I
at look
don't
at
care
gold's
about gold.
performance. I don't care if you care about it. I hate it too.
Ugh.
But look at gold's performance since March 10th.
Yeah. Well,
And
China's
not
been
only
buying
has
a
it
lot
hit
of gold,
all-time
right?
highs, and this is this may not be a strong indicator of institutional money flow outside of Comex, right? But it's a very good indicator of where retail is putting money, because there's still a very significant chunk of retail investors that believe gold is a safe haven against inflation and against,
Yeah.
or a safe storage of their wealth. And gold is rocketing.
Do we think that that's what's happening to Bitcoin right now too? Is this like
To some degree,
Gen
yeah. I
Gen
think I
Gen
think I think
Z's
there's
gold?
a yeah. I think millennials think that Bitcoin might be a safe haven, right? So millennials are fleeing to BTC, boomers are fleeing to gold. They're both
And
idiots, right?
it's a
But
tale as old as time.
yeah, no one ever learns from the lessons of the previous generation.
Yeah, I think we had some. I think it was either representatives or senators pushed a bill recently to try to get back on the gold standard. That apparently that sentiment will never die.
That'll never, yeah, but that'll also never happen. It's ridiculous.
I know. I mean, we might as well just peg the dollar to Beanie Babies or something, right?
Sure.
Anyway, we all know how I feel about gold. Another thing I wanted to talk about, because we were just talking a lot about where money's flying, right, to money markets. I think a lot of people, now that we're a month out from the banking failures, have sort of thought like, oh, this is sort of under control. It's transient. It's kind of gone away. We've sort of patched that hole. Where's the next hole?
Well, except
But I think
yields kept rising. Yields are rising again. The 5 years up 4% on last Thursday.
And this is my issue, is that money, certainly the rate of flow out of banks has slowed.
Yeah.
But it has not turned back around. It's still sharply negative, and I think it's just a very simple fact that when the banks imploded, and then it was all over the news. Everybody and their mother realized, oh shit, I'm not making any money in my bank. I can throw my money into, a risk-free, short-term fund of some kind and make 4 to 5%, right? And so I think that very simple dynamic, which has not been corrected, is just going to continue until something else breaks in the banking sector.
You know what I love is that all the brokerages, since they can offer higher yields on held capital because they're custodial holders, right? They don't have to reinvest. And so all the brokerages are offering like 4 to 4.5% on cash positions held in the brokerage.
Yeah.
It's fucking insane because you get yields on your fucking CSPs. So you're getting 4% annualized yield on top of any CSP sold. Right? Because that cash is, I mean, it's held, but it's still accruing the annualized interest rate.
Yeah, and I think
so I think we're going to see people like more informed investors, or people who are more closely managing their wealth, are going to start pumping their money out of their banks into their brokerages, where it's arguably safer.
Yeah, I mean, why? I mean, that's the thing. It's such an
What's that? You cut out. You've strayed too far from your Wi-Fi. I know, the pains of owning a giant home.
How about now?
Better.
All right. Yeah, so I mean, it's such an easy value proposition for anyone to understand. Nothing. Move your money to this website, make something.
Yeah, and runs, or these exchanges of money are faster than they've ever been, right? It used to be you'd have to like go to your bank, get a check cut, fucking or wire your funds. Like you have to go to the bank and fill out a wire thing and wire your funds to your brokerage. Now you can do it online in like 5 seconds.
Yeah, I know.
And it's so easy to just be like, I'm going to pull $3 million out of here and put it there.
Personally attacked again.
I'm sorry. Again. I'm not targeting you. I swear. I would never do something like that.
No, yeah. I mean, it'll be interesting to see. It's kind of like a what breaks first kind of thing. I mean, everybody's running on more credit than they ever have, right? The affordability of homes have never been worse, even during the 2008 crisis. And so it's just kind of an interesting, what's going to break first,
I mean, part of it's scary is because if something big enough breaks, and we've spent so much time propping up these small failures, right? Like, with the Fed's backstop and creating their little extra repo environment, and trying to improve the liquidity in the treasury market, trying to improve the dollar liquidity, like all of these things that are kind of minute, but ease short-term pressures. We're compounding these like long-term problems And if anything on a bigger scale breaks before something small does, we could be looking at a recession that lasts a very, very long time. And that really sucks. um,
Yeah.
like,
I mean, part of me thinks that I'm, becoming a doomer, and it makes me feel crazy. Um, because certainly, as much as we've learned in the last few years, I'm certainly not a market historian. I don't know how it felt in some of these. I remember 2008, but I was still in school at the time. I was fairly insulated from that
yeah,
dynamic.
same,
Um,
same.
but it just seems bad. And I feel like people are you don't have to think the world's ending tomorrow to more appropriately assess risk than is being done now. I think people are just being way too optimistic. And yeah, I agree. It could get really bad. I don't know what's going to spark it, but we've had easy money for a long time, and now that easy money's gone, and things are going to break.
I mean, I think I'm just going to continue to approach the shorter time frames that I play the market on in a similar way. I'm gonna carry short-term coverage of any long side potential and continue to build short positions, right? Because so far that's been a very, very successful strategy. Um, I should probably be more wary of the upside than I am, so I'll try to factor that in. But yeah, I don't think any bullish momentum is sustainable in the macro environment. However,
Yeah,
however
no,
strong it may seem, I think it all just. I mean, it's been true for the last year and a half. I think it'll continue to be true.
but I mean, the bullishness is going to have to be ripped out of the Bulls' dead hands, right? I mean, they will hold
Always,
on to
always
it until the
does.
last. Yeah.
Yeah,
So yeah, I kind of agree with you. I need to anticipate more bullishness than I have. And I mean, as we all kind of have seen over and over and over again, if the Fed is good at anything, it's good at slowing down the inevitable. And so anticipate that they'll always be able to kick the can farther than you think.
yep.
So who was it? Who said this? Was it Kashkari? I think on 60 Minutes said that the Fed has infinite money.
Oh yeah, I think it was. Yeah.
Oh my
I mean,
gosh!
J-Pow
Imagine.
said that at one point too. They were like, "Well,
Oh
how
my
do you make the
gosh!
money?" He's like, "Well, we just create it digitally."
Yeah, I think, but like, I don't know how they don't realize. I mean, they probably do, but I wouldn't be so bold as to say that in an inflationary environment. Like your band-aid of printing infinite money that you've been using for the last 15 years, you can't really use it anymore, right? You
Yeah,
can you can try to thread the needle, but you're probably just going to have to let some things deflate, and it's going to be ugly. It's going to be ugly.
I agree.
People still, I mean, I know this is anecdotal, but I can't find people to do work in my house because they can't get enough help for the wages that they can offer because the job market's too tight. People can make more for less work,
Yep.
doing something else. And this, I mean, I've heard small businesses in my town sort of echo the same thing. Um, so I mean, people said that this last print that things are cooling, but to me, it just kind of seemed flat.
I
I
just
mean,
hope
there's
it
a
gets
lot of
bad enough that we cap corporate profits. Can we just get out there and like build some guillotines and you know
I mean, if we haven't already built guillotines now, I think we're just gonna,
just gonna accept our fate?
yeah.
Yeah, probably.
I mean, yeah. France, at least admire France for lighting things on fire.
They love to do that shit.
Yeah, it's one of their best qualities, actually.
Mm-hmm.
Um, but yeah, all right. Well, I don't think there's really much else to talk about. So,
Probably not. It also sounds like you're being invaded by children, so I'll let you go, man.
yep, invaded by all matter of species.
All right, I'll talk
All
to you
right.
later.
Well,
Thanks for coming on, man.
another fun week.
Yep.
Yeah.
Later. All right. Well, I think that about covers everything we wanted to talk about today. And yes, I do know that the bearish sentiment around here persists, but um, be cautious of the potential for upside this coming week. I'll write more on it tonight in Pickles Picks. Um, but there is a good chance that we can stay, especially on flat data, that we can stay in this upper range between 40.75 and like 41.20, maybe even surpassing both of those limits fractionally, until enough positioning is built up in one direction or the other for us to make a serious move. So, and after the move over the last week, where we moved up like 380 BPS or whatever, I think that it could take some time to build enough positioning that we start to see some serious moves. Now, whether that will be CPI or SLD remains to be seen. But I think that'll be heavily dependent on the data that comes out. If inflation comes out hot, we'll probably start to see some of that downside realized sooner rather than later. If it doesn't, it's relatively flat. We'll probably be waiting until momentum turns into the SLD period, and some of the price performance can be realized to the downside. So be cautious. I think I don't know how you guys feel about this, but the way I laid out kind of the ranges for the week going into this week, I'm always trying to like make this easier for people to understand. The previous week I tried to do it, day by day, but doing that requires adjustments throughout the week, as especially if we're in a week where price is shifting like we were previously. We started in this range, but then ultimately moved into the more bullish range about halfway through the week, right? And so that changes, the projected outcome. I think something like this is better because it simplifies, the middle range. And then, people know if we're crossing up into this range, things are getting more bullish. If we're moving down into this range, things are getting more bearish, right? And, positions can be skewed to encapsulate, the downside or upside risk. So I think I'm going to stick with this if you guys liked it, and found that more helpful as a means of determining, how to hedge and where to position. Most of this week stayed pretty flat, right? So within these ranges. And so, obviously we had some bullish skew here and, some or bearish skew here and bullish skew here, as we moved, up and down from the other ranges, and things turned a little more bullish here, but obviously like we started to turn back around, right? And so I think this is a good way for outlining it in the future. You need to label the boxes with timestamps of the different price points. Is it too hard to read on the axis? I can draw. I'll draw lines. I'll just put lines in so you guys get a little tag over here. But essentially, I mean, through the last week, we were trading basically between gamma, like long-term gamma neutral and short-term gamma neutral. So I don't think this week will be much different. Don't forget that there's going to be a lot of neutral positioning because CPI and PPI are back to back. That's going to slow everything down and contract volume and liquidity. You should draw buy and sell arrows and then put the order in my account for me. Jokes aside, thanks, Poopy Bands. What Poopy said. Yeah, so without directly telling anybody how to manage their own portfolio, because I wouldn't want to intentionally skew anyone's sentiment outside of providing the data. I think this is a better way to approach this. I was using this before last week, and I think this is a better way to approach things because it more highlights the bullish versus bearish range and forward expectations when we cross over, right? So, you know, here it's very indicative that like we're moving towards a more bearish range. You know, when volume flattens out here, you know, that you know, infers a bounce, and then you can confirm the bounce here, right? And then you can follow that trend to the upside of the range. And I think that's more helpful. All right, guys. So I'll have Pickles picks out tonight. Thank you all so much for tuning in. I appreciate it. Are you expecting Jimmy to ride along with the market this week? I guess I could touch on that before I shut all this down. Jimmy looks like it's getting more illiquid. I think risk is minimized due to the lack of long-term interest, and IV has plummeted. I think the last really significant stronghold of long-term interest on GME was in before earnings and then closed. I think we need to see options on the chain, or this is the IV is probably only going to get worse over time. So since Superstonk is never going to buy leaps on GME, right? We're going to need something to incentivize a new class of investors to come in. And unfortunately, one positive earnings in our historically best quarter is not going to be sufficient to do that. If they're able to continue positive earnings, maybe. But for GME to regain its volatility and create the FTDs necessary for cyclical volatile price action, it needs a group, a larger group of people that are saying, I think this stock is worth more in 2024 or 2025, what have you, and put that additional obligation onto the market maker via the purchase of leaps. If those come in, and institutions or individual investors do begin to believe that, then I think we will see the retail leverage, the price volatility that DRS creates. And until they do, we're going to remain low on FTDs and volatile price action. At least long-lived volatile price action. Raytheon? I could take a quick look at it. I mean, some expectations of, I don't know, I want to say like, this is probably a combination of both, you know, continued political friction, and the war in Ukraine. But I don't know. I'd have to do like a higher, like a higher order analysis of it to really determine if this is worth a buy. I mean, it's already really expensive, right? I mean, their growth is consistent. I mean, obviously, like CAGR across the defense sector is generally high. So you know they have very consistent growth, but then I don't know if this is gonna like skyrocket. I don't think it's very undervalued right now. But yeah, I would have to do a far deeper analysis to make that kind of determination. I mean, from a technical standpoint, it looks kind of like it's topped. And then, you know, people who bought in fucking October are going to want to sell. I guess speculation could pick up if any kind of like actual conflict started beyond Ukraine, but right now, I don't think political posturing alone is sufficient. Order backlogs are great, right? And determining future earnings potential. But being unable to satisfy those orders and having a backlog is bearish, right? So it's, like I said, it can be really hard to determine these. This is kind of like, in a way, and what you're describing at least is very much why I had to go much deeper into FSLR's financials, because they have this enormous, like, on the surface they look extremely bullish. Like, people just won't stop buying from them. They've got money flooding in from the government, but they can't meet their demand, right? And if the supplier fails to meet the demand, you ultimately get a failure, a breakdown. People will go to other places to get who will meet their demand or match it at least, right? So over a longer time frame, that can be really, really bearish. And the company can lose face, if you will. So yeah, I would have to do far deeper dive into that than I can do just right now. But if you message me about it or try to just keep up a conversation about it, I'll probably take a look at it at some point. I've been wanting to maybe get a position in some defense stocks. I don't particularly like it. My general expectation is that defense will always perform at a relatively consistent rate, because superpowers are not incentivized to go to war with each other in any significant way. And so, and then, prop conflicts tend to not generate huge amounts of revenue or change in the industry, since they're constantly ongoing. Happy Easter, everyone. Thank you so much for tuning in. If you have any questions you didn't get to ask them on the stream, feel free to reach out to me. I'll be around for most of the rest of the day. Have a great night, everybody. See you later.